So late 2007, the financial world is basically imploding, right? Wall Street firms are collapsing, losing like a decade of profits in just
Yeah,
months.
it was chaos.
Yeah.
Absolute chaos.
But in the middle of all that, there's this one investor, John Paulson, and somehow he's not just surviving, he's making huge amounts of money.
It's an incredible story. It became known as the greatest trade ever recorded. For good reason.
And just paint the picture for a second. You had, what, 1 in 10 Americans delinquent on their mortgages?
Or foreclosure, yeah. Housing prices had tanked, like
Yeah.
over 30% down from the peak in '06.
Millions lost their homes,
Mm.
people underwater on their mortgages, just devastation everywhere.
And yet, Paulson and this small group of others, kind of outsiders really, they saw it coming. They thrived.
So that's our mission today, isn't it? To unpack how this happened.
Exactly. How did these, well, relatively unknown investors predict this meltdown when all the experts are completely blindsided?
And why Paulson? You know, he wasn't some real estate guru, not like the big names, Bill Gross or Mike Veranos.
Right. Why him? And we'll even touch on how Warren Buffett missed it, and George Soros actually called Paulson, asking basically, how did you do that?
Okay, so let's dive into the sources. We're going to pull out the key bits, the important details, to help you understand what went down, how, and why it's still relevant. Let's start with Paulson himself. His background, it's not your typical Wall Street story at all.
No, definitely not.
Uh,
Initially, people described him as, solid, careful, even decidedly unspectacular.
And his investment style, that focus on just grinding out the research, long hours,
Yeah.
it seemed almost, outmoded.
Yeah, compared to the fancy computer models and leveraged bets everyone else was making. But maybe that was his edge.
Interesting. So tell us about his roots.
Well, he grew up middle class in Queens, New York.
Yeah?
Got some early financial insights from his grandfather, actually.
Oh, yeah.
Yeah, a businessman who lost a fortune back in the Great Depression. So maybe that instilled a certain caution or respect for numbers.
Makes sense. There's even that story about him selling Charms candies in kindergarten.
Huh? Yeah. Selling them one by one shows some early entrepreneurial spirit, I guess.
And he was clearly smart. Top of his class at NYU, then Harvard Business School.
Definitely bright. And at Harvard, he got inspired by these Goldman Sachs guys like Robert Rubin, talking about mergers and acquisitions.
But the real eye-opener was Jerry Kohlberg, right? The leveraged buyout pioneer.
Absolutely. Kohlberg showed how a tiny cash investment could balloon into millions.
Mhm.
It made typical Wall Street pay seem puny, as the source puts it.
So with all that talent, why consulting first, not finance?
Higher starting salary, apparently. Simple as that sometimes.
Huh.
But that consulting job was crucial. A senior guy there, Jeffrey Libert, challenged Paulson's early view on real estate.
How so?
Libert showed him that historically, after inflation, housing only returned like 1.5% a year. Tiny.
Wow, okay. Not the gold mine everyone assumes. That little detail stuck with him then.
You bet it did. It became critical later on.
So his early career was a bit of a zigzag. Oppenheimer, Odyssey Partners, Bear Stearns, working crazy hours.
Yeah, 100-hour weeks at Bear. And he learned that lesson from a colleague. A salesman's job starts when the customer says no. Persistence.
Seems like he was driven. Personally, things settled down a bit later.
Yeah, described as having a wilder bachelorhood, but married his assistant, Jenny Zaharia, in 2000.
Yeah.
Quieter life after that.
But still hungry, right? By 2005, he's 49, feeling like it's the twilight years, but wanting that one big trade.
Exactly. Still needed to prove his mettle, despite his success. And interestingly, even as he got richer, his office stayed pretty basic.
Like Spartan even.
Yeah.
Kept an old couch.
Yeah, a used couch from Bloomingdale's warehouse. And an old Jaguar that literally caught fire. Not flashy.
Okay, so that sets the stage. Now, the spark for the big trade. How did that happen?
It started when Paulson just felt the market was getting way too speculative, like a casino.
Right.
So he turned to his analyst, Paolo Pellegrini, and basically asked, is there a bubble somewhere we can short, something we can bet against?
And Pellegrini. He's quite a character himself, isn't he?
Oh, yeah. Brilliant guy, Italian-born, but had a really rough career path.
Yeah.
Struggled with his accent, got passed over, fired from Lazard.
Hit zero net worth at one point.
Yeah, at 45.
Yeah.
And Paulson hired him even after Pellegrini apparently managed to piss off Paulson's partners in the interview.
So Paulson saw the talent, maybe the edge.
Must have. And Pellegrini was the perfect guy for this research task. He needed an elegant solution to prove the housing bubble existed.
So what did he find?
He went deep into interest rates, academic papers, all of it, and found that stunning contrast. U.S. home prices, historically, only up about 1.4% a year from 75 to 2000.
Okay, that number again.
Right. But then, from 2000 to 2005, they soared over 7% a year.
That's a massive difference.
Huge. His analysis showed prices needed to drop almost 40% just to get back to the long-term trend line.
40%.
And historically, when prices fell, they didn't just stop at the trend line, they fell through it. So the potential drop was, well, brutal.
That's the intellectual ammo Paulson needed.
Absolutely. The core idea, housing isn't always a safe bet. And the kicker,
What was that?
the cost of insuring against these mortgages, defaulting using those credit default swaps, CDS was dirt cheap.
How cheap?
Like 1% a year, just 1%. Paulson told his research director, "There's never been an opportunity like this," he called it.
The El Dorado of investments.
You got it. Low risk, potentially astronomical reward.
It still blows my mind. If Pellegrini could find this, why couldn't the rest of Wall Street? All those experts.
Yeah, it's the central question, isn't it? I think a big part of it was just the mood. By 2005, Wall Street was basically a raging multi-year party.
Everyone was making money.
Pretty much.
Yeah.
Especially hedge funds. After the dot-com bust in 2000, they became the hot thing. They seemed to have the magic formula, making money no matter what the market did.
The holy grail of investing.
That's what it felt like. Money poured in, top talent went there. Running a hedge fund was suddenly downright sexy.
So complacency, greed.
Both, probably. And there was this deeper cultural thing too, right? The American dream.
The love affair with the notion of owning a home.
Exactly. That, combined with financial innovation, really changed how people thought about debt. Specifically, this thing called securitization.
Okay, break that down. What is it?
Well, it started back in '77. Basically, lenders could bundle up tons of mortgages, thousands maybe, package them into a bond, and sell that bond to investors.
So they get the loans off their books.
Right. It makes more money available for new loans, which sounds good, but it also means the original lender doesn't care as much if the borrower can actually repay.
Ah, I see. They've already sold the risk off to someone else.
Precisely. And that fueled this explosion in subprime mortgages loans to people with shaky credit. Went from like 4% of mortgages in '93 to 25% by 2005.
A quarter of all mortgages were subprime. Wow.
And the types of loans.
Yeah.
It was like an all-you-can-eat buffet of risk.
Interest only, adjustable rates with crazy low teaser rates.
Yep. Piggyback loans, so you didn't need any down payment. Liar loans, where they didn't even check your income properly.
Just took your word for it.
Often, yeah. And the infamous NIN-YO loans.
No income, no job, and no assets. NINJ.
Crazy, isn't it? By 2005, almost a quarter of all mortgages had zero down payment.
So, where were the regulators in all this? Anyone watching the store?
That's what you'd hope, right? But Fed Chairman Alan Greenspan actually seemed to encourage adjustable rate mortgages in a 2004 speech.
Really?
Yeah. And later he basically said, well, we didn't see a crash coming because we'd never really had a big national housing crash before.
That doesn't sound very reassuring.
Not really. And internally at the rating agencies like S&P, there were emails. One exec called a deal ridiculous.
And the reply was?
Something like, we rate every deal. It could be structured by cows and we would rate it.
Structured by cows. That's bleak.
Tells you everything, doesn't it?
Yeah.
Another manager said, let's hope we are all wealthy and retired by the time his house of cards falters. Just pure cynicism.
So the whole system was just blind. Firms took these risky loans, bundled them up.
Through securitization, yeah. And slapped shiny AAA-rated labels on them, turning gold from dross, supposedly.
And investors bought them based on the rating.
Absolutely. Some big institutions had standing orders. Buy any U.S. debt-rated AAA, they often didn't even realize they were buying bundles of dodgy mortgages.
They just trusted the label.
They did. And the anecdotes are just wild. Strawberry pickers making maybe $300 a week, getting a $720,000 mortgage. Zero down.
How is that even possible? The payments must have been huge.
$4,800 a month to start. Unsustainable. Or the mariachi singer whose income was verified with a photo of him in his outfit.
A photo? Seriously?
Seriously. Most traders, they just weren't looking at house prices. They were obsessed with interest rates, complex models.
They missed the big picture.
Totally. As one source put it, they were so busy looking at the limbs of each tree, they didn't even know the forest existed.
Okay, so a few people did see the forest. Paulson, Pellegrini. But how do you actually bet against the entire housing market? That seems impossible.
It was tricky. And this is where those credit default swaps, the CDS, become absolutely central.
The insurance policies.
Exactly. And Michael Burry plays a key role here. He's another fascinating character.
The former medical student. Managed money from home.
That's him. Had Asperger's, taught himself finance, basically devoured this dense book on CDS.
And he saw their potential.
He saw them as the perfect way to make this bet. You pay the premium, but your potential loss is capped, right? You only lose the premiums you pay.
Unlike shorting a stock where losses can be infinite.
Right. And Burry actually anticipated that Wall Street would have to create standardized CDS contracts specifically for these toxic mortgage bonds.
He told his broker it was going to be huge.
Yeah, it's going to happen. You'll be selling it eventually. He called it his Soros trade, thinking big.
And at the same time, you've got Greg Lippman at Deutsche Bank.
Yes, the guy with the slicked back hair and the sushi guide.
Yeah.
A real nonconformist.
And he was pushing to standardize these CDS contracts, too.
He was spearheading it, working with rivals, believe it or not. He and this math whiz, Eugene Zhu, proved something crucial.
What was that?
That the only thing that really mattered for mortgage defaults wasn't the economy or interest rates.
Yeah.
It was just house prices. If prices fell, defaults would soar.
So Lippman knew these bonds were toast.
He declared, these things are going to blow up. He was convinced.
So the standardization happens. Now there's a tool to short the market.
It's a game changer. It gives Paulson, Burry, and others the mechanism they need. But it wasn't easy money yet.
Because of the cost, right? The negative carry.
Exactly. You had to pay those premiums day after day, week after week while you waited for the crash. Lippman's team was burning through $50 million a year just on those premiums.
$50 million. His colleagues must have thought he was nuts.
They called him crazy. It took real conviction to stick with that bet.
And that pressure must have been immense for all these guys, the bears.
Oh, absolutely. Look at Burry. His investors started bailing in late 2006, pulled out $150 million.
Why? They don't believe him.
They thought his argument was too simple, that he was still learning. He was forced to sell nearly half his CDS protection at a huge loss.
Ouch. Giving away the family jewels, he called it.
Yeah, he apparently got really sullen, reclusive, blasted heavy metal in his office. His staff were scared to go near him. You can feel the strain.
And Jeffrey Green, Paulson's friend, the real estate guy.
He was struggling too. He'd bet $1 billion against housing, put down $60 million for the CDS protection.
It then got hit with margin calls.
Millions in margin calls when prices didn't drop immediately. He thought the market was rigged.
And he tried talking to Jamie Dimon at JP Morgan.
Yeah, tried to explain the trades. Got a blank look. Dimon was either bored or doesn't understand, Green thought. Shows how niche this view still was.
Incredible. And Andrew Ledet, the guy living on tuna.
Yeah, tough story. Lost his job, got tiny severance, trying to start his own fund, literally eating cheap to save money.
Spent days on the beach looking for investors.
Desperate. Finally found one guy who gave him $6.5 million. Just enough to place his bets against these AA-rated mortgage slices.
Which sounded crazy even to the investor.
Totally radical. It just shows the isolation and struggle of being right too early.
So for months, they're just waiting, bleeding money on premiums. The market isn't cracking yet.
Right. New Century, that big subprime lender, was still posting record earnings unbelievably.
Even though Paulson suspected they were worse than others.
Yeah, he looked at their loans and thought, they're lying through their teeth. It's just not possible. He got pretty emotional about it, apparently.
Calling them predators.
Yeah, these guys are preying on poor people. He really saw the human cost.
Then, February 2007, the turning point.
Finally, news breaks. New Century has to take back billions in bad loans. The stock just collapses, plunges 36% in one day.
Paulson's first big win.
Yeah, the first real crack in the dam, yeah.
And the very next day. This is amazing. The ABX index, that subprime tracker.
It drops 5 points, which might not sound like much, but Paulson had insurance on $25 billion worth of this stuff.
So a 5-point drop on $25 billion. Do the math.
It's $1.25 billion.
Yeah.
Instantly, in his pocket.
1.25 billion? In a morning?
More than Soros made betting against the pound. The scale is just staggering.
Unbelievable. His fund must have rocketed.
Climbed 66%. 66 in that 1 month.
Investors didn't believe it.
They called up asking if it was a typo. It's 6.6%, right? Not 66. Suddenly, Paulson's so-called amateurs were schooling the pros.
But even then, even with billions rolling in, Paulson stayed paranoid almost.
Focus, definitely. He worried Bear Stearns might be manipulating things, swapping out bad loans in the portfolios his CDS are based on.
And he suspected banks were hiding losses on their books, cooking the books, basically.
Yeah, overstating the value of their own CDO holdings. He even got an associate to write to the SEC, questioning their accounting practices.
He wasn't just betting, he was trying to expose the rot.
Seems like it. And he had this key insight. Even if the banks sold off CDS protection, the total losses were going to be so huge, the buyers of that protection wouldn't be able to pay up.
Meaning the banks would still be on the hook.
Exactly. They're stuck, he told a friend. He saw the systemic risk.
And that story about his nanny.
Oh, right. He found out his own nanny, an immigrant, had defaulted on credit cards, phone bills, but could still get more credit.
It showed the debt problem was everywhere, not just mortgages.
Yeah, it was a symptom of a much wider issue.
Then comes July 2007. The Bear Stearns hedge funds collapse.
Two big ones, heavily invested in mortgages, that sent shockwaves. And the price of Paulson's insurance, his CDS, just went through the roof.
And that's when he had that meeting, stepped out, came back grinning.
Yeah, the billion-dollar-day story. He comes back into the meeting with potential investors, looking almost jovial, apparently.
With a Cheshire grin.
Right. And just blurts out, "We just got our marks for the day. We made $1 billion today."
Imagine being in that room, just casually dropping that news.
The impact on his team was immense, too. Pellegrini, his key analyst.
You got a nice bonus.
Nice is an understatement.
Yeah.
$175 million bonus for 2007. His wife found $45 million just landed in their checking account one day.
Wow. And Paulson himself.
Nearly $4 billion in personal profit for 2007 alone. The biggest single-year payout ever in financial history, apparently.
$4 billion. It's hard to even comprehend.
It really is.
So the crisis keeps rolling. February 2008, Paulson's now this huge figure. He has lunch with the COO of Bear Stearns.
And he doesn't hold back. He publicly grills the guy about Bear's risky assets, their level 2 and level 3 stuff.
The illiquid things.
Exactly. Paulson had done his homework. He points out Bear has $220 billion of this stuff against only $14 billion in equity. Meaning, as Paulson put it, a small movement in the assets can wipe out your equity completely.
Talk about putting someone on the spot.
It was described as a dagger in the staggering investment bank's heart. Money started flooding out of Bear Stearns after that.
And a month later,
an emergency sale to J.P. Morgan for just $2 a share, basically wiped out.
And Paulson had already moved his firm's money out of Bear.
Months earlier.
Yeah.
Shifted it into safe treasury bonds. He saw it coming and protected himself. Smart move.
Bear Stearns was just the start, though. Lehman Brothers followed.
Yeah, despite their CEO trying to sound confident, they were drowning in bad real estate bets. Filed for bankruptcy in September 2008.
The biggest bankruptcy ever in the U.S. by far.
6 times larger than any before it. That's what really triggered the global panic. Government scrambling, bailouts, the whole meltdown.
So reflecting on all this, what are the big takeaways for us listening?
Well, it's obviously a story about financial brilliance, seeing what others missed. But it's maybe more about systemic failure, isn't it?
And human behavior, groupthink, greed, fear.
All of it. Remember Andrew Lade, the guy who retired after making his money?
Yeah, wrote that scathing letter.
Railed against the idiots from fancy schools running Wall Street. His advice: throw the BlackBerry away and enjoy life.
And he said waiting was key. Sitting and waiting is how we made money.
That contrarian patience, it's rare.
Such a contrast with Paulson. He made $6 billion personally, $20 billion for his firm. Became this legendary figure.
The Midas touch.
Yeah.
Any stock he touched soared.
But still takes the train to work. Says he just needs transportation.
Remarkably grounded in some ways, which contrasts sharply with the victims, like the Montesses, those strawberry pickers.
They lost their home, struggled for years.
Yeah. Cutting out basics, always one plumbing problem away from default. The human cost was immense and lasting.
So this whole deep dive, it makes you wonder about bubbles, doesn't it?
Definitely. Jeremy Grantham, the investor, points out there have been like 28 major bubbles globally since 1920.
Right.
Maybe markets aren't getting more efficient.
Maybe less. With all the complexity now.
Could be. And if the experts and regulators couldn't see this one coming, how do you, the listener, spot the next big thing, the next easy way to score sure profits before it blows up?
Or avoid the next collapse. Paulson himself said, winning Wimbledon once isn't enough. You want to win again. Is the cycle just endless?
That's the unsettling question, isn't it? Are we just destined to repeat these patterns?
Well, that was our deep dive into the greatest trade ever, an incredible story about the people who bet against the world and won.
We really hope digging into this gives you maybe a different way to look at markets, the psychology behind them, and yeah, this seemingly endless cycle of boom and bust.
Join us next time for another deep dive. We'll unpack more sources, pull out those nuggets of knowledge, and try to help you stay well informed.